While there are a lot of money facts and stats that are out there, but at this point, the following are the ones you need to hear about immediately because they can and are affecting your lives every single day. So join us in this journey as we dive deep into some of the craziest statistics that are sure to surprise you. Number 1. People spend more money when using credit. There are a few reasons why people may tend to spend more money when using credit. Credit cards can make it easier to make impulse purchases. When using a credit card, you don't have to physically hand over cash, which can make it easier to make impulse purchases without fully considering the financial consequences. Credit cards often have higher spending limits. Credit cards often have higher spending limits than debit cards or cash, which can make it easier to make larger purchases without having to save up in advance. Credit cards may offer rewards or other incentives. Many credit cards offer rewards or other incentives for using the card, such as cashback or points for travel. These incentives can make it more appealing to use the card, even if it means spending more money. Credit cards make it easier to overspend. When using a credit card, it can be easy to lose track of how much you are spending and to overspend. This is because you may not feel the same sense of pain when making a purchase with a credit card as you would if you were spending cash. Overall, there are a number of factors that can contribute to people spending more money when using credit, including the ease of making impulse purchases, higher spending limits, rewards and incentives, and the potential to overspend. It's important to be mindful of these factors and to use credit responsibly to avoid overspending and getting into debt. Number 2. 50% of Americans cannot afford a $1,000 emergency. Unexpected crisis can happen to anyone at any time, whether it's a medical issue, an auto repair, or a job loss. Did you realize that ambulance transport for someone without insurance might cost more than $1,000? Possibly even $2,000? Or that between $500 and $600 is the typical cost of an auto repair? Even scarier is the fact that the vast majority of Americans lack the resources necessary to pay for these unforeseen expenses. A 2018 survey found that 34% of American households had a significant unforeseen expense in the previous year, and only 39% of respondents said they would be able to pay a $1,000 price tag out of their savings. In literal actuality, the following are some stats that show how Americans handle unforeseen expenses. 39% use savings to cover the fees. 13% cut back on other expenses, while 19% finance the amount with a credit card and pay it off over time. 12% of people take out personal loans, whereas 5% borrow money from relatives or friends. It is clear that a sizable section of the population, if not the entire population, only budgets for the short term because they must rely on credit, loans, and other forms of borrowing. Even though it's challenging to plan for the future, particularly given that many Americans live paycheck to paycheck, and prioritizing fulfilling essential requirements, having an emergency fund is essential since it gives you financial security and eases your mind. By creating a safety net that may be used in emergencies to cover unforeseen costs, an emergency fund improves financial stability by minimizing the need to use high-interest debt products like credit cards and predatory loans. You are less likely to declare bankruptcy or accumulate excessive debt if you have an emergency fund. While it may be more difficult said than done, it is nevertheless possible and essential to save money while also making payments on monthly obligations, paying down a credit card or student loan debt, and pursuing other financial objectives. Just cautious preparation and perhaps some sacrifice will be required. 7 days a week. Say goodbye to takeout. Number 3. 33% of Americans have saved 0% for their retirement. It's not uncommon for individuals to struggle with savings portion of their income, especially if they're living paycheck to paycheck or have high expenses or debts. Most Americans aren't saving enough for their retirement, according to a recent survey which found that 33% of participants had no retirement savings and 23% had less than $10,000. Due to the gender pay disparity, greater life expectancies, and an investment gap, women are significantly more at risk. Comparatively to 52% of men, 63% of women, or over 2/3, claim to have no savings or less than $10,000. This might add up to $1 million over time because women invest and save for retirement substantially less than men do. age and retirement savings are highly connected. Given that they have been in employment for the least amount of time, millennials are least likely to have a sizable retirement fund. Millennials claim to have no retirement savings in the amount of 42%. In contrast, 30% of respondents have saved less than $10,000, while 28% have saved more than $10,000. How does this affect the majority of Americans? It's possible that the difficulties in forming a retirement fund serve as a compelling argument against participating. Opening a retirement savings account may be seen as a hassle due to the lack of knowledge surrounding retirement planning, the increasingly bleak outlook for the future, and the challenges associated with rolling over assets when changing jobs. Saving money now and consistently will make a big difference for young people who are just starting out in their careers. Use compounding interest, or the process of adding accumulative interest in the main deposit to your advantage. Even a modest sum, saved early and topped up frequently, could guarantee a comfortable retirement. When starting your work, many financial advisors advise saving 10 to 15% of your income in a retirement account. Saving even 5% of your income might have a significant impact over time, especially if your employer matches. Always take advantage of employer matching because it can allow you to save more money overall with less individual commitment, as it would seem so. Number 4. 40% of Americans plan to work until they die. A significant study shows that 40% of Americans plan to work until they die. So, if a consequential percentage of Americans plan to work until they die, it could have a number of potential impacts. Some of the potential impacts could include a strain on the economy. If a large portion of the population is working well into their retirement years, it could lead to a shortage of job opportunities for younger workers and potentially contribute to a skills gap. A decline in the quality of life for older workers. Working until they die may mean that older workers are not able to fully retire and enjoy their latter years. This could lead to physical and mental health problems as a result of working long hours and not being able to fully relax and enjoy their retirement. An increased burden on Social Security. If more people are working longer and drawing a salary, they may be less likely to rely on Social Security as a source of income in retirement. This could put an additional strain on the Social Security system, which is already facing financial challenges. Despite all this, what would happen when you are no longer able to work and there are bills yet to be paid? Moreover, at that age, moving with family members or moving at all, or putting the burden on them for your ill mistakes? This is a very horrifying scenario that you need to carefully think about. It's important for individuals to plan their retirement and to consider a variety of sources of income, including savings, investments, and potential Social Security, in order to ensure a comfortable and secure retirement. Number 5. 40% of student loan attendees are expected to default by the year 2023. Over the past 10 years, the amount of student loan debt in the United States has tripled, reaching $1.5 trillion. Furthermore, the outlook for those who are still paying off student loans is getting worse. When you take out a loan from a lender, you consent to the conditions laid out for the loan repayment. You run the risk of becoming in default on your loan if you don't make payments on time. After a prolonged period of delinquency, a loan default or failure to repay a loan occurs, and the loan amount is forwarded to a collection agency. Depending on the time frames specified in your loan conditions and applicable state or federal legislation, default may happen right after or after a number of months of missed payments. Nearly 1 in 4 student borrowers, more than 1 million students per year, default on their loans within 4 years of graduating from college. Within 2 years, 19% of students default on their private loans and 29% of students default on their federal student loans. Nearly 40% of debtors are anticipated to default on their college debts by 2023. This is hardly surprising given the instability of post-college life and the uncertainties surrounding job prospects. Borrowers could experience financial hardships and struggle to make their student loan repayments. Additionally, defaulters' credit scores suffer greatly. The average credit score of people who have defaulted on student loans is 550, which is regarded as being on the verge of subprime credit. The average score for debtors who are in good standing is in the upper 600s. Low credit score individuals frequently pay higher interest rates, encounter difficulties renting, are put off or are unable to purchase homes, and might even be excluded from certain employment opportunities. Due to collection costs and accumulative interest, defaulting even results in an increase in a student loan borrower's amount. Wage garnishment, tax offsets, the suspension or revocation of state-issued professional licenses, and license suspension are just a few of the other unfavorable consequences of student loan default. Hence, it is important to take note that when student loans or any other type of debt, it is imperative to make proactive measures. Consider grants, scholarships, and part-time jobs to reduce the amount of student loan debt you incur if you are a current or prospective student. These are some of the craziest stats that were an absolute necessity for you to know so that when you are aware of them, you can take the necessary measures required in order to free yourself of these and lead a life of financial freedom. Let us know what you think about the stats in the comments section below.